Alrighty, good morning everybody. Thank you all so much for tuning on in. Today we are going to be talking about bonds. So before we begin, I want to just provide a little brief outline of the video. So first of all, I'm going to talk about what bonds are. Then the second thing I'm going to be talking about is the different kinds of bonds you can buy. Then the third thing I'll be talking about is the ratings and sort of providing an explanation as to why bonds are rated a certain way and how that affects how they're priced and what kind of yield they have. So let's get started. So the first thing we need to establish is what is a bond. So in the simplest terms, a bond is a way for a company or a municipality to raise money. If a county government needed money for a road immediately, what they would do is issue a bunch of bonds to pay for a $5 million road. They'd say, we'll pay 4% interest every year for the next 20 years, but we'll issue, we'll say $10 million worth of bonds. And so they're paying 4% interest on that $10 million to whoever bought the bonds. So you could buy $1,000 worth, and then every year you would get $40, which is nice. It's a little bit better than just, putting your money in a bank or buying a certificate of deposit. So the drawback to doing that is you're paying a little bit higher interest rate, if you're the one issuing the bond. But, you have the money right then, right there, and it's a good way to raise money immediately. So, why would you want to buy a bond? Well, for one, it does not have the yield that a stock does. Like I said earlier, it's 4%, 5%, maybe 6% per year. But it's much safer and much less risky than buying a stock, and it has a little bit better yield than a certificate of deposit. Plus, bonds can be bought and sold on what's called a secondary market. So after that entity had issued the bonds, whether it's McDonald's paying for a parking lot or a city paying for a sewer, the bonds can go up in value or go down in value. So for instance, you might have a bond that has a face value of $100 that will be a little bit crazy and say it pays 6% interest. And then, well, if you need money immediately right then and right there, you can sell it to somebody else who wants the bond for 6% interest. And sometimes, people will be willing to pay a little bit more. So as an example, you could sell that 6% bond for $110 and get some money that way. You don't get the 6% interest every year, but somebody's willing to pay $110 for a $100 bond, and that's more money in your pocket than you can go and buy stocks with that 10% profit you made. Then likewise too, if the entity that issued the bond suddenly looks less reliable, what could happen is, the face value might drop. And so it might be a $100 bond, but it's looking like they might not pay their interest back. And so what could happen is that bond might be selling for $90 or $80 on the secondary market, which means that it has a lot higher yield. They're still paying 6% on $100, but you're getting that 6% on $100 on $90 or $80. So that's how bonds work. Now, let's talk a little bit about who issues bonds. In the 6 assets that you should invest in video, I talked a little bit about who issues them, but mainly the big 3 are the United States federal government, municipalities, and then corporations. So the U.S. federal government, they typically don't have that high of a yield. I think right now it's like 0.8% or 0.9%. Not a whole lot of yield, but it's very reliable. Then the next in line is municipalities. And you might want to buy a municipal bond, or they call it a muni, because it's tax exempt. So if you live in New Jersey or California or Connecticut or Pennsylvania or New York, where the taxes are really high, you could buy a municipal bond where you don't have to pay any taxes. And then the last category is the corporate bond. So when an airline needs money to buy airplanes and they don't want to issue new stocks and they don't want to take out a loan, what they can do is issue bonds, and you get to hold their debt for a little bit. They get to buy new airplanes. Everybody wins. So those are the 3 entities that will typically issue bonds. Let's talk a little bit about bond ratings. So typically there are three large rating agencies. There's Standard & Poor's, or S&P, there's Moody's, and then there's Fitch. Standard & Poor's and Fitch uses a bond rating system where it's AAA is the best, then AA, then single A, then triple B behind single A, then double B, then single B, and then I think they either have triple C or just regular C. You don't really want to go below single B. And within that rating system, you know, you could have AAA plus, AAA minus, then AA plus. So there are like sub ratings within that rating system. So if we want to just put it into two categories, there's investment grade and below investment grade, which is also referred to as junk. So you've heard investment grade bonds and maybe junk bonds. And investment grade bonds are anything triple B and higher. Junk bonds are double B and lower. And the default rates will vary. Typically AA and above will never default, but they don't have very good yield. Likewise, you know, in recessions, double B and single B have a high chance of default. When things are going smooth, they don't default normally, but during recessions, you know, you see spikes in the default rate. But you might consider adding lower rated bonds to your portfolio because they have higher yield. You know, you could get, I think, around 6% for triple B, and then double B, sometimes you can get 7 or 8%, at least now. Later on in 2020, we'll see how things go in the coming months. But as of early October 2020, you can expect around 6% for a triple B rated bond. Okay, so before we close out this video, I just want to show y'all how the bond market works and how buying and selling works on Vanguard. So to start, what we do is go to My Accounts, Buy and Sell. So we click Buy and Sell, pulls up this page, and you say check rates and trade bonds. So it pulls up this page. I might blur some of this out. So then you select your relevant account, say continue. From there, you see all your options here. You know, you can buy certificates of deposits, U.S. Treasuries, U.S. agency bonds, municipals and corporates. And then on top of that, if you want, you know, a more advanced search, you could say, I want to buy some junk bonds, some double B minus, rated up to A. And we'll search. So it takes a minute to load, but here we are. And here you can see Nordstrom, they're selling bonds. They give about 8.7% yield. Dillard's, Mainstream Partners, that's probably an oil company, Marathon Oil. Of course, that is an oil company. As an example, let's check out this Nordstrom bond here. So we'll go to buy. And here we have all this information. So here you have the security type. It's a corporate bond. The issue is Nordstrom. It matures on January 15th, 2044, and they pay 5% interest, and it's paid semi-annually. Next payment date is the 15th of January in 2021. Anyway, there's all these options, which we can talk about a little bit more later on, but basically it has the price at issue and then the yield at issue, and then how many bonds were issued, and so on and so forth. So here it also has the ratings. In this case, Standard & Poor's has it rated double B plus. Decent bond. It's the highest rated of the junk bonds, so you know it's cream of the garbage, so to speak. And here there's the survivor option and conditional put. Conditional put is an option here. So what that means is if the rating on this bond, double B plus, if it goes down, you can put the price back at $100 per bond. So something to keep in mind. That's really all I want to talk about. Now we're going to go into actually buying the bond. So let's buy. To actually buy it, we say I've reviewed the features. I've read the product description. Then how many do I want to buy? I'll buy 2. Calculate. It costs me 73 bucks on $100, so 73 cents on the dollar. So I'll be paying $1,470 for $2,000 worth of this bond. I'll also have to pay the interest that's been accrued. Then I'll also have to pay $2 in commission. So in total, I'll be paying $1,496.44, just these two added up. And I will get that interest payment relatively soon, hopefully. So let's continue. We just say submit. And voila, we have bought the bond. The order was submitted, and that's how bonds are bought. So I will be getting 7.393% interest, that junk bond yield. Very nice. That's the end of this little section. Alrighty, so that concludes the video. We've talked about bonds, what they are, why you should buy them, who issues them, what ratings are, and then we've also gone through how to buy a bond. And so with that, that concludes the video. Thank you so much for watching. If you liked it, give it a like. If you have any questions, leave a question in the comment below, and then I'll see you in the next video. Thank you so much for watching.